So for this particular session, we're going to be actually focusing on one single metric. It's a crowd favorite, the MVRV ratio. This is a tool that has been around really since the origins of on-chain analysis. You know, it kind of comes from the realized price and the realized cap, which really are some of the most foundational metrics, and to this day carry some of the most significance. The MVRV ratio is then a derivative of that, originally developed by Murad Mammadov and Dave Puel. So this is something that's kind of been around for a long time, but at least in my experience as an analyst, is massively underexplored and underappreciated in many regards. So what we're going to look at today is kind of a bit of a snapshot and a deep dive into the MVRV, really exploring some of the different profiles of what we can do with it. We will do about 30 minutes of content, and then we'll close out with a session of Q&A. So if you do have any questions, there is a question form in this Zoom call. So do feel free to put those questions in and we will come through and get to them at the end. All right, let's get stuck into it. So the humble MVRV ratio. So this is one of the most popular metrics. As I mentioned, it's been around for pretty much as long as on-chain analysis as a discipline has been itself. And really lots of people look at it as a macro oscillator, which it of course is. But under the surface, when we actually digest and understand what exactly the MVRV ratio is doing, what is it presenting us? What does up mean and down mean, and high values and low values? When you actually look at the underlying bones of what this thing is doing, it is providing us a view on the unrealized profit and loss held within the entire Bitcoin network. So the way to think about this, and for any of you who've been kind of absorbing our video content or our webinars in the past, you'll know that I love to bring in the layer of human psychology. So if the MVRV ratio is basically charting out current price, which is market value, spot price, market cap, divided by realized price, which we often consider to be the acquisition price. So the current value divided by the acquisition value, that will give you a profit multiple. When it's above 1, it's going to give you we are in profit. When it's below 1, it's going to give you we are in loss on average. And the psychological concept here is that at some point in time, everybody sees a green enough number in their portfolio that they feel motivated to sell. And likewise, at the very, very bottom of bear markets, there's only so much pain that the human can take. And when we look at our financial portfolio and it's just red, 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 at some point in time, that elicits the same response of people flushing out their coins. So that's why it tends to work on these extremes. We're looking at points in time when people become exceedingly likely to distribute their coins, and that generally triggers some kind of cycle change. So what we're going to do in this particular session is focus on that kind of core properties. We'll explore just the vanilla MVRV itself. We're going to look at some probabilistic frameworks and some tooling and just kind of ways that I think about these types of metrics. We're going to look at how we can actually identify market extremes and actually convert that into pricing levels, right? Which just makes it a bit easier. It's the same data, but presented in a different way. And we'll also look at market trends and divergences. So there's a lot going on in terms of what the MVRV is capable of, more than just an oscillator that goes up in bulls and down in bears. So let's get into Glassnode Studio and we will start this thing off. So all of the charts that you'll see today, we do have a dashboard here. We actually have one for both Bitcoin and Ethereum. You'll find it in our dashboard suite under profit and loss for both of those assets. And there is actually a report here, Mastering the MVRV Ratio, which will take you through those elements. But obviously, you know, it's a bit more fun to do it live in the session. So let's jump into Studio itself. This is the humble MVRV ratio. You'll see that we do have a dashed line down here at a value of 1. That is essentially the break-even level. So I mentioned that MVRV is an unrealized profit and loss multiple. Look at all of the coins in the market. How much profit is the system in if it's above 1, and how much loss is it in if it's below 1? And as I said, it does trend, right? Obviously between bull markets and bear markets. But really, for most people, when we look at this kind of thing, if we just bring into that frame of reference of a macro oscillator, what we're really looking for is extreme values. What do we actually consider to be a blow-off top type territory? And what do we consider to be undervalued? Right now, some of these, when you kind of eyeball things in, you can say, well, okay, if it's below 1, it's probably, and we typically see it down near cycle lows, 2018 and 2015. And when it gets above maybe 2.4 or 3, that's typically getting into some overheated territory. But what I want to do is bring this a step forward and apply some kind of a framework to actually measuring that, right? Because it's all well and good to eyeball in a number and say, yeah, it's high. But what does that actually mean from a more mechanical and systematic perspective? So there's another thing we can do here with the MVRV. This is kind of the first, just a very, very simple model that we can use to actually track trends, right? So we can take this thing and look at extremes. We can also look at trends. So this here is just plotting the MVRV ratio against its 1 year moving average. And you will notice that in the week on chain and in many of our reports, we will do this. We call this momentum typically, where we're looking at a faster moving average, maybe a monthly, or in this case, just the raw metric itself, and it's 1 year moving average, because that's kind of the longer term baseline. So what we're doing here is measuring when do we get these periods where the cycle has changed. Now, why this is really important, you'll notice here in 2017 and in May 2021, and even back here in 2013, note that we drop very, very quickly, and it typically breaks through that 1 year moving average with some conviction. And this is after spending a significant amount of time above it. The reason why is that, remember, this is an unrealized profit multiple. We're coming off a level where the market is extremely in profit, but then suddenly is extremely not in profit. And remember, in this market cycle up here, we actually, here was the previous correction up here about 6,000, 7,000 before the final parabolic run. We traded down to that same level. But you can see that the profitability of the entire market absolutely collapsed. So if you think about that, price has gone up, gone to a very high profit multiple, but then collapsed well and truly below where it came from. So there is much less, significantly less profit in the system following that event. This can only happen when there's been a lot of redistribution. Coins have been transferred on this final parabolic run. Many coins have gone from a cost basis of $200, $300, $500, $1,000, $3,000 up to a cost basis of $20,000. So now that you have coins at a much higher cost basis, the MVRV ratio, this momentum break to the downside, is signaling that we probably have a significant trend shift underway. The same is true when we come to these upside moves. In 2019 was a great example, 2015, another great example. Typically when it breaks above that 1 year moving average, it is generally because there's a whole lot of people who've just capitulated out. Their coins have been distributed to the lows. Somebody else has come in and actually acquired those coins. There's been a changing of hands. And you'll often hear me say that it is much easier to hold a coin when you're in the green than it is when you're deep in the red. What we're seeing is that switching over of psychology. There's new buyers, new holders. The market has essentially reestablished a new equilibrium. So what we get is these very, very sharp breaks to the upside actually creates a degree of profitability that we haven't seen for a long time. It's a trend shift. So in a really, really simple mechanic, we're actually looking for those sharp moves that typically signal a bit of a trend shift in the overall market. But in the underlying fundamentals, it's actually a whole bunch of people who were in profit suddenly are in a loss, or at bottoms, it's a whole lot of people who are in a loss, capitulating out, and then returning to a profit. So we're seeing this kind of changing of hands showing up in the MVRV ratio. Now, the other thing I want to touch on just quickly before we get into some of the statistics is a bit of the mechanics, so we just understand what's going on here. That concept that we just talked about in terms of shifting profitability, this happens on both a macro and a micro timescale. So this chart here, we've got two traces. We've got the realized cap itself, which is obviously what the MVRV is derived from. It's kind of the on-chain cost basis is the right way to think about this. It's the valuing every coin at the price when it last moved. And then in the green, we've got realized profit. Now, what that means is if a coin was bought at 5,000 and it's spent at 10,000, there's a $5,000 profit times the coin size, right? 0.5 BTC or whatever it is that's on the move. Now, what you'll see is that during periods of heavy profit taking, this realized cap will climb because people are revaluing cheap coins to expensive coins, quite often selling to a buyer who it's their first coin. Bull markets are very common for the smart money from the previous bear market to have very cheap coins, basically doing the exact opposite of what the market should be doing, which is the new money coming in and saying, hey, I love this $60,000 Bitcoin, despite the fact that in many instances, it's the exact wrong time. Now you can see that there was this second leg We had this second rally from August through to November 2021. And we've covered this quite a bit. This was a bit of a funny rally. It didn't really have the momentum behind it. And we're going to discuss what was going on there. But you can see that we had this second rally, these extra profits were taken, and we had a second push higher. The 2022 bear market, we then essentially flushed out all of that capital and we returned. We essentially flushed out all that excess speculative premium, got removed from the market. But the important thing to note is that the peak profits were occurring at the exact top, which is literally profit taking. And that's those coins getting transferred up to a higher level, higher cost basis, more price sensitive. So we can look at that concept and the signals that the MVRV is telling us on a macro and a micro scale. So on the left-hand side here, this is the macro scale. What we're looking at here is MVRV between the two 2021 peaks. Now, price was at a higher level in October and November, but there was less profit. You can see this big negative divergence that's in play. There is less profit in the system despite price being higher. And you have to wonder, well, how does that happen? Because the average cost basis of the market was much higher. There was literally less profit in the system because the average cost basis was up at a higher level. And the reason why that cost basis was at a higher level is because a whole stack of people took profits on one and then two peaks. So what this is really describing, this big negative divergence here, is describing a top-heavy market. You're seeing in a situation where price is higher, but there's less profit. You've got a top-heavy market. There's lots of coins located up in that $50,000, $60,000 realm. And then you can basically, when price falls below that, you have a much more sensitive market. Any kind of price below, suddenly people start going, hang on a second, I'm no longer in the green. And people start to get panicky, and then the bear market ensues. And naturally, these things all happen within the context of everything else, right? You've got macro and various other indicators, but essentially this is providing you a nice framework to say, well, at the very least, within the context of Bitcoin, I know that this market is far more sensitive right now at this all-time high than we were at the previous one. So it gives you a bit of a context. Now, let's flip that around. Let's just imagine in 12 months, 18 months, 2 years' time, we're back up at all-time high, right? 70,000. Because there's going to be a whole lot of those coins bought at 50, 60,000 that have been reallocated down at here at 20 or 30 or 40. This MVRV ratio, in theory, should be much higher. If, on the other hand, we get up to that all-time high, if price gets back to 70,000, and we have yet again another very low MVRV ratio, you start saying, hang on a second, and we've also got profits being taken. You start to think maybe this thing doesn't quite have the legs yet, because you're seeing people distributing and basically taking those profits. Now, that same concept applies at a micro scale as well. You can see here in the April to May 2021 peak, higher and higher highs in price, but decaying profitability. This is literally the process of distribution taking place, which you can see distribution taking place as profits were taken all the way through this topping pattern, which, as we all know, how that story played out. And we can actually see this in our 2013 and 2017 cycle as well. In 2013, price actually rallied between the two peaks. It was up 392%. And yet MVRV at the all-time highs was actually lower. So even though price was up 392%, the amount of unrealized profit in the system was much less. 2017, very, very similar story. We got up to these levels and we started seeing a decaying or a weakening of our overall MVRV, despite price being up 65%, 56%, and then blow off top. And actually, you can see at the all-time high itself, we also had a negative divergence. So the MVRV can be used to try and gauge risk in this market as things are starting to devolve and you're seeing coins transferring around the system. This is kind of at a macro and a micro scale. You can start to observe whereabouts the system is in terms of that profit taking when you've got risk in the market, top heavy, and obviously you can then break this down into various cohorts and look at this in even more detail. Okay, so that's kind of the concept and the structure and what the MVRV at a big picture, just some of the use cases that certainly I pay attention to. What we're going to do now is a bit of an exercise to show you how I think about probability, right? How do we make this a more actionable tool? Because it's all well and good to be looking at divergences and getting really in the weeds. But for many people, we're just looking for what classifies as an extreme value. Now, the first approach that I mentioned before is just to eyeball in some levels. So here I've put in some levels here at 3.2 at the top, 2.4, right? Two levels that kind of represent like super overheated and hot. And I've also got levels here at 1, which is actually break-even price or at the MVRV, and then 0.8, which is a 20% discount. Now, these are just eyeballed in, right? I've just kind of picked numbers that seem to catch, oh, that looks about right. But obviously the market can change and evolve over time. So it's not the most robust system, but the concept will still carry forward. So now that we've got these levels, how do we actually assign a probability framework? How do I give some kind of robust level to say, well, maybe that will work, and with what kind of percentage probability? So a tool that I like to use, this is in Workbench, we're using an if statement here. What I'm basically saying is that let's just take the level of 3.2, which is our red curve. If MVRV is above that level, return 1. If MVRV is below that level, return 0. So for every trading day, and I'm going to do a cumulative sum. So for every trading day, let's say there's been 300 days out of the 6,000 that Bitcoin's been trading, that we've been above it. I've got a ratio of 300 days above, 6,000 below. Give me that as a percentage. That's essentially what this metric is doing for those 4 different levels. So the way to think about this, let's take our red curve here. At our current level, we're somewhere between 6.5, 7, kind of in that ballpark. You can see it's actually been quite stable for more than 5 years now. So we're talking about somewhere between, let's just say 5 and 7% of all trading days have been above that level. Well, that means that 95% of all trading days have been below it. So if I see an MVRV that's above 3.2, I know that there's only 5% of all history. And the logic here, only 5% of the time have investors been willing to sit there and go, I love this green portfolio, and not put a top in. So when I'm above that level, we're talking about a fairly improbable scenario. When I'm below that level, that's kind of the mean. That's the norm. 95% of the time, we're below that. So therefore, human behavior is probably going to start stepping in when you get above that level. Likewise, for the blue curve, this is the one 20% below. The market's at a 20% loss. This one here, we're talking about 3.9%, 4%, 5%. So similar ballpark. For round numbers, let's just say 5%. 95% of the time, MVRV is greater than 0.8. So therefore, if we reach a number that's at 0.8, it's an improbable scenario. We can start to assign probabilities to these things. And you will see here that, yes, I eyeballed in those horizontal levels, but they're also rough. There's a bit of logic and thought behind it. Our very extreme, both to the upside and downside level, about 5%, meaning 95% probability that we're outside those bounds. For the other two, somewhere between about 15 and 20%, right? So I'm looking for things that represent extremely overheated with 5% probability, and stuff that's starting to get hot or cold, which is in that 15 to 20% type range. But this is just a really simple framework to understand how likely is it that this level is going to be hit or tagged. So what we can then do is use the if statement to essentially put some really nice color bands onto this thing. And we can start to identify periods where we are in heated and overheated territory, or we are in cool and extremely cool territory. So we can use that tool to then say, if price or MVRV is below 0.8, it means that I have a 95% probability that it wants to be higher than 0.8 over any kind of long term. Now, naturally, all of this assumes that MVRV continues to do what it does. But the nice thing about it is that we're essentially basing it in one of the most fundamental metrics, which is the realized price. And the realized price is going to react to every single transaction on chain. So therefore, your assumptions boil down to, if people continue to move coins around on chain at a meaningful level, then we can expect that this thing will continue to represent some kind of unrealized profit and loss ratio. So we're trying to simplify and nullify risks of this thing deviating over the long term. But the other assumption we've got here is we've just eyeballed in horizontal levels. Well, what happens if Bitcoin really does grow and we end up at a 10 trillion or $100 trillion asset, and volatility squeezes out and profit multiples of 320% no longer really matter? What happens if our base assumption here is that those horizontal levels is actually, that's kind of the weakest point in this analysis, because we've eyeballed it in, and we're just kind of hoping that those horizontal levels remain long term. So we'll come back to that in a second. The last thing that we can do is, because all the MVRV is just a ratio between spot price and the realized price, well, if we've got an MVRV of 2, that means that price is trading at 2 times the realized price. So you can actually multiply. We've now got our 4 extreme levels, 3.2, 2.4, 1, and 0.8. Let's multiply the realized price by that to develop pricing levels. So what this is essentially capturing, and you can actually see these levels where things got really heated in 2017, things got really heated in 2021. This is the price level where there's only a 5% chance that we've ever been above it. It's basically saying that if you reach that kind of pricing level, that's where the human behavior that we've been talking about, the I'm in so much profit, I need to take it, or I'm in so much loss, I need to get out of this thing. We're looking at the pricing levels where we would typically see that type of behavior kick into gear. So it's just giving us a bit of a frame of reference on where we sit within the market. And what I like to, you can see here that during the bear market, we tend to sit between these 2 behavior levels. And then we go through this long process of transitioning up to the heated zone. And once we break into this heated zone, typically speaking, here we are in December 2020, here we are back here in early 2017, we're typically breaking the previous all-time high. So generally speaking, we see lots of things kick into gear. Bitcoin is just surprisingly cyclical. As we break the previous all-time high, smart money start to distribute in larger size. It starts showing up in headlines, new buyers come in, and you go through this extreme. It's like this big kind of TikTok that goes back to front, where you see all of the bull market mania shows up, and then you cool down and you have all the bear market catastrophe. And these things tend to show up in very, very similar cyclical patterns. So in order to address the horizontal level problem, which is basically the most arbitrary part of what we've got here, we can actually use a bit more robust and meaningful methodology. So the blue curve that I've got here, and again, I'm using Workbench to calculate this. I'm just doing a cumulative mean. This is basically calculating the all-time average. What is the all-time average of MVRV? And this is essentially going to follow as MVRV evolves. You can see it's actually quite stable over time. But as MVRV evolves and changes and moves over time, this thing will follow and adjust. You can also set this to like a 4-year basis. So I've got some ghost traces here to show you what we do if we do a 4-year average. There's all sorts of things we can do, but for the sake of simplicity, we're just going to do an all-time average. Now, for those who are familiar with statistics, we can also then measure how many standard deviations above, in this instance, 1 above in the red, or 1 standard deviation below in the green. You can start to set up, okay, show me a statistically meaningful deviation. When are we actually well and truly outside those boundaries? Now, of course, there's a little bit of arbitrary. What classifies as significant? 1 standard deviation, 2, half. That kind of number then comes into it. But very typically, if we're looking at plus or minus 1 standard deviation, it will give us a reasonable bound. And that's where we're going to keep it simple here. But we're essentially, it's a bit more of a statistical framework rather than just a horizontal level and kind of finger in the air, measuring days and things like that. So what we can then do is calculate via that exact same methodology. Let's just use our mean plus 1 standard deviation in the red, mean minus 1 standard deviation in the blue. And again, you can start to identify periods in time where the MVRV is extremely hot. We're seeing there's a lot of profit in the system. People are more likely to start spending. Likewise, during our bottoms, we're seeing that point in time when there's so much red that people start flushing out. You get a changing of hands, and that typically puts in a cycle change in both directions. Now, naturally, you can compare this to that momentum oscillator we looked at the start, and you can start seeing how MVRV just by itself gives us a really, really nice framework for what's going on across the market. You start getting confluence across many of these elements. Have we seen a trend shift? Have we seen a bunch of profitability drop out of the market? Have we seen that we're at a 1.2 or 1.5 standard deviation from the mean? You can start gluing these pieces together and saying, do we have all of these divergences in play, and thus a cycle change may well be underway. And again, it's based on that human behavior pattern. And we can also calculate via the exact same mean a series of pricing bands, right? Plus or minus whatever standard deviation level we want to look at. Here I've just plotted out -1, -0.5, +0.5, +1. But you can see we essentially achieve a very, very similar result where you can start looking for periods in time when the market is just well and truly out of bounds. And it's time to just start saying, yeah, this is getting pretty heated. Start looking for those divergences, right? We're above this red band. You can see in 2017, for example, we were above this level for some time. So we can persist in an overheated state for some time. Likewise at the bear market, we can be down here for several months, 6 months, 8 months. These are not short-term things, but it's a signal to start maybe looking for those divergences in the opposite direction, right? So it gives you a bit of a framework to say, all right, now I can start thinking about, are we in superheated territory? And what are the metrics I need to then look at from that point onwards? And likewise, when you're at lows of bears, you can start changing that framework and saying, all right, start looking for that capitulation behavior, start looking for that changing of hands, sharp moves in percent supply and profit, things like that. So it just helps you orient yourself within the maze of markets. So that framework that I just walked you through, that concept of taking standard deviation bands and different levels in terms of what we're looking at in terms of statistical levels, we can apply that not only to MVRV, we can also apply that to many other oscillators with a little bit of work here and there. But the other day we actually released this dashboard, which glues together that exact same framework using the cumulative mean and the standard deviations for 4 crowd favorite metrics. MVRV ratio, which is unrealized profit and loss. We're trying to capture different segments of the market. So is the market in an extreme level of profit or loss on paper? SOPA, which is saying, is the market locking in extreme profit or loss on both sides? The pure multiple, which is then saying, are miner revenues at some kind of extreme? Are the production side, typically miners operating at the extremes? At the bottom of a bear market, they're selling into an already weak market, they're capitulating, they have to empty their balance sheets, they're under extraordinary stress. And in a bull market, they're mining coins, typically at a power price that's much lower than the current price. And as price goes higher, those 900 BTC become an increasingly large USD sell side. So we're looking at the mining perspective or the production side. And the last one is the reserve risk, which is capturing the amount of hodling that's taking place. So essentially, we can start to distill all 4 of these to say, do we have all 4 of them out of bounds? And that's what this signal is trying to capture. It's trying to pick up points in time when we have miners in an extreme amount of profit. We have the markets in an extreme amount of profit. People are taking extreme profits, and the amount of hodling is pretty much at an all-time low, pushing reserve risk higher. So when you have all of those conditions, it starts looking like you have some kind of market cycle peak. When you have all 4 of those conditions in the exact opposite, everybody's underwater. Everybody who's selling is doing so at a significant loss. The miners are under extraordinary pressure and their revenues are wrecked. And then the last component is hodling at all-time high, because the hodlers are the ones willing to step in during the most bearish price action. So this tool, which you'll find under our signal section, again, this is all available for our advanced members, is essentially distilling down those concepts for each of these 4 metrics using our mean and plus or minus standard deviation bands, and then just simply aggregating them together. So that's the snapshot or the run through of just some of the many things you can do with the MVRV ratio. Let me just jump back to my cover slide, because we will start to move into some questions. So as I mentioned, everything that we just went through in that session is contained within that MVRV report. And you will also see there's the live dashboard for both Bitcoin and Ethereum covering every single step of that process. And then that signals dashboard is also now live for all advanced members. So you can, there's a free trial to get you started with advanced. But really that's what we're trying to do, is break down these concepts, help apply a bit of a probability framework to things, help people use these tools to navigate market extremes. And there's lots of ways you can use it. You can use it for just spotting market extremes. You can use it for trying to just change your bull versus bear market thinking. you can use it as a bit of a compass to try and just work out whereabouts we are in the cycle. But really, at the end of the day, it comes down to at what level do we engage and kind of fire up people to make the same decisions. And this is the thing I try to impress upon people. For on-chain analysis is just a beautiful tool for visualizing human behavior. And while the asset may change, the year may change, the market may change, Jay Powell's comments may change, all these things in the world will change. But the reason we can still chart price action back in the 1920s and it looks exactly the same as today is essentially because the human behavior pattern, our response to fear and greed and profit and loss are pretty much the same, right? The human ape brain doesn't change, despite the fact that the asset and everything else does. So on-chain analysis is just the first time we can actually see this printed out block by block for these assets, which are just incredibly emotive, right? That's kind of the part of the nature of these things. So with that said, let's move across to question and answer and see if there's any queries that have come up. Let me find the Q&A tab. Okay. Okay, so first question here, can you please explain young supply realized price and old supply realized price in the last research report? Great question. So what we're looking at here is, let's start with old supply. When we're looking at old supply and young supply, or long-term and short-term supply, what we're really doing is trying to understand the different components of the market. And if we did some research some time back now, actually, I think 2020, that was kind of associated with our long-term, short-term supply. And the concept here is that when we look at, statistically speaking, when you look at all of the coins within the Bitcoin network, generally speaking, those that are older than 5 or 6 months, somewhere around the threshold, about 150, 155 days, the probability that they get spent is significantly lower. It declines below 1%. It's like a very rapid decay. So any coin that's older than 5 or 6 months, it's very improbable. Similar concept to what we just looked at in terms of probabilities. It is unlikely on a relative basis they get spent. Conversely, the young supply, the coins that are younger than that 5-6 month threshold, those coins make up the vast majority, like 99 point something%. So what you're basically looking at there is that the young suppliers, you can also think about like the liquid or the active or the mobile. Young supply is the stuff that's always churning. And if you think about from this perspective, I don't particularly care. As a trader or an analyst, I don't particularly care that the guy who bought yesterday sold today, or the guy that bought 2 days ago sold today, because it's all just kind of part of the mix, right? It's part of the daily trade volume. What actually matters is the guy who bought his coins 5 months, 6 months, 1 year, 5 years. What happens if a bunch of those old supply start spending? So when we're looking at their realized price, what we're doing is breaking these out into age-based and therefore probability-based cohorts. And what we've seen historically through Bitcoin's market cycle is that those old supply, the older hands, the people who essentially have held their coins for a long period of time, generally speaking, they start distributing and spending their coins en masse during 2 particular events. One, when we break above the previous all-time high. Generally speaking, those longer-term holders start spending en masse because they see that Bitcoin is getting expensive. They bought their coins much cheaper and they start realizing profits into the raging bull market. The other place that we see them spending is actually, well, maybe not quite so much right now, but certainly a couple of months ago, we see them at the very, very bottom. Why? Because bear markets typically last for longer than 5 to 6 months. In this case, and by my count, I believe that the bear market started in May 2021. That's kind of when the psychology shifted, which what MVRV also showed us as well. That psychology changed. Those old hands, 5 to 6 months, are actually top buyers at that point in time. People who bought during the 2020 to 21 cycle or 22 cycle, they typically become the old hands, the old supply. And you can see that their realized price will go up and up and up. And the higher it goes, it's showing you that the average acquisition price of those buyers is substantially higher. So what we're looking for there is that young supply typically follows the price. It's much more responsive because it's daily churn. The old supply realized price is trying to capture those folks who essentially are either the smart money who bought in the bear and are selling in the bull, or the people who were bought at the top and have finally just seen enough. They often drive that price action at the extremes, whereas the young supply kind of picks up all the daily trade and the daily momentum, how that works out. Okay. So question here, which exchanges are used to calculate BTC prices and volumes? What percent of transactions do I believe are captured by the above? And are these all on-chain transfers? So for what we're doing, we use an aggregated price. So in terms of what the spot price is, generally speaking, I mean, Bitcoin's a bit of a unique asset because generally a stock trades on the New York Stock Exchange, and that's kind of its home. That's where it lives. That's where its price action happens. Bitcoin is unique in the sense, well, this industry, digital assets are unique in that they trade all over the place in different places around the world. So we use an aggregated price to try and map out where that is. In many instances, it's kind of, plus or minus. It doesn't, the actual delta in terms of what the precise price is. As long as you're not looking at an exchange that's got extraordinarily high spreads, we typically see that between the major exchanges, which form the bulk of the pricing, you typically get arbitrage that keeps them very, very close together over time. The realized price is then looking at the price at the point when each coin moved. So at a block by block level, we look at each UTXO and we assign the price when it was transacted, because each transaction has a timestamp. The block that transaction is in has a timestamp. So we take that timestamp, we assess what the price was at that time, and we assign it to that UTXO. And from that point, when it's spent again and mined into a block, we can measure the price delta and therefore the value delta. So it is the MVRV, spot price, market cap, off-chain. Realized price, realized cap in the denominator, on-chain. And we're gluing those two together. So it's a bit of a meld between those two. The other way, actually, just one final point on that to think about this. For MVRV, you've got market value, which is basically the price that everybody sees, right? And then you've got the realized price, which is actually individual. What we do is we aggregate it to be a holistic view of the whole market. But my realized price is different to your realized price because you and I acquired our coins at different times. So the realized price is actually, it's much more divergent. Actually, every single coin has its own realized price. What we're doing with MVRV is gluing these things all together and just looking at an average across the whole market. And bring it back to that previous point, we can do short-term holder MVRV, only looking at the profit and loss held by recently moved supply. Or we can do long-term holder MVRV, only looking at the overall behavior of coins that are held by older hands. So you can actually break that down even further. Okay, how would I classify MVRV divergences for daily analysis and swing trades? Is it a leading or a lagging indicator? It can actually be both. So, and again, it kind of depends where you sit in the cycle. You can see that those divergences, basically what you're looking at is at these peaks, it's about relative levels, right? Are we seeing more profit enter the system as price goes higher? As we come out of bear markets, small price changes, and you'll see this in things like percent supply and profit as well. As you start to come off the lows, a very small price change, 10%, can create 13, 14, 15, 20% increases in the amount of supply and profit. So during those transition points, typically MVRV is very, very responsive, right? The amount of movement is very responsive. Over the macro scale, that's where you look for these just much larger divergences. So it does actually work as you bring it down to finer timeframes. You will see these things like, does the percent change of MVRV match the percent change of price? So you can go down to actually quite fine detail and even within micro peaks and things like that. So certainly it will tell you what's going on in those certain levels. But remember, the underlying basis is we're looking at changes in coin distribution. Small changes in coin distribution may not change the market very much, but at market cycle tops, you get the most extreme changes. You get very, very large sums being distributed near the top. So it kind of scales alongside the market. When we're just kind of day-to-day chop, MVRV will be less responsive because the difference between the market being in 130% profit and 140% profit, but the difference between being in 240% and 320%, that's a very significant change that typically happens over a very, very short time scale. So it does kind of change. Okay, so a question here on the link between MVRVZ score and the probability lines. So the Z score is literally plotting out how many standard deviations we are. So that second version where I have the cumulative mean and then cumulative mean plus or minus 1 standard deviation, MVRVZ score is literally plotting out how many standard deviations we are away. So if MVRVZ is at 1, that means we are at that top +1 standard deviation band. If MVRVZ is at -1, it means we're at that lower level, that blue band. So it's actually plotting this out in a pure statistical framework. That's exactly what MVRVZ is doing. Is there a way to use MVRV to spot the Picotop of the cycle? It seems price keeps going up even when it's in red territory. So the answer is there is no metric tool answer to the Picotop. And looking for one is generally the problem is that if you look for too many of these things, trying to look for the Picotop, the reality is the market could do something completely different, right? And if there was a perfect answer to these things, everybody would be rich and we wouldn't have to sit here in a webinar. The concept here, you're absolutely right. It will break above that red band. And remember, the selection of that +1 standard deviation, that's the arbitrary decision that we made for this. And the reason why is you just do plus or minus 1. And we're trying to spot just overheated conditions. You could refine that. You could use MVRVZ score and you could look for levels. You could look for levels that are within your framework, right? You could actually have a level for +1, +1.5, +2, and you can establish, like, the higher this thing goes. Remember that probability framework. 95% of the time, we're below it, but there's still 5% where we're above, and sometimes we're much above. What if that was 2% or 1% or 0.5%? The thing, what you're doing there is you will start getting into Picotop territory, so to speak. If you keep incrementing up how high do you want to go? The trade-off is that the more your percentage goes down to 1%, 0.5%, you may not hit it. So if that makes sense, you may actually not get to that level because the market just happens to be different that particular cycle. So the answer is you can do that. But the challenge is you're then reducing the probability that event happens in the first place. So, you know, there's no solutions, only trade-offs. It certainly falls into that bucket. Okay, great question here. Can you unpack the realized price calculation given how much of the acquisitions BTC take place off-chain? Fantastic question. There is a workbench chart or a couple of workbench charts in our presets under the exchanges category. And they are designed to answer this very question. A lot of people don't realize this, but every single day, hundreds of millions to billions of dollars of Bitcoin flows in and out, both directions. So when you look at exchange net flows, it's like, you know, 3,000 Bitcoin, 4,000 Bitcoin, 10,000 Bitcoin's a big day, but that's net. That's inflows minus outflows. Inflows are typically like 50, 60, 80, 100,000 BTC. And outflows are 50, 60, 80, 100,000 BTC. So this is actually a question that I contended with quite a bit in the 2021-22 cycle as I myself am growing as an analyst. I was trying to understand this question because I saw lots of people saying, you know, oh, all the trading happens off chain. Well, that's true. But the inflows and outflows is typically somewhere between like 30 and sometimes 70% of spot volume. It's huge. So there is a stack of volume flowing in and out. The other thing with Bitcoin is that the data is quite clean in the sense that there's not that many DEXs, certainly not ones with any kind of significant volume on Bitcoin. So when people are buying and selling, those coins are still going in and out of exchange. So the way to think about this, the realized price, if you look at the realized price on an individual basis, I may buy my coins at 30,000 and then I may withdraw them at 40,000. So the on-chain transaction will pick up a $10,000 difference. But I still made a decision to withdraw at 40,000. I didn't sell, I chose to withdraw it. And then when I send it back, I kind of don't have a choice, right? You're going to see it because it's on-chain. So in many ways, when you look at it at an individual level, yeah, there's some error bars. But when you look at it in scale, over time, in aggregate, you still see these patterns play out time and time again. And a lot of this is driven by the fact that the coin volume, flowing in and out is just truly extraordinary. So if you do want to have a look at this, there's a USD and a BTC version of this. Go and look at on Workbench under exchanges, look at how small net flow is, and this tiny little black squiggly line compared to the green and red, which is just enormous on both sides. So that's generally how I would answer that question. Would I combine MVRV with a momentum-based oscillator? Yeah, to find support and resistance. Absolutely. MVRV is one of these really nice things to help you orient yourself. Are we in market conditions that look like we're in a more constructive environment? Are we seeing sharp changes? So in many ways, MVRV is great to actually assess and help orient yourself large. And like, for many people, help you get your longer term timeframes in check. And then you can go looking at all your other indicators within that framework. For some of you who are actually really in the weeds and looking at those micro divergences, it can then also be part of that internal framework. But really, if there's kind of a takeaway, I think for most advanced members, having this tool as kind of that grounding anchor to just understand where we are in the cycle of things is probably a nice way to go about it. We've got another question here in terms of self-transfers and consolidations. Yes, in terms of self-transfers and things, there will be some, that's again, some signal loss there. That said, we also have our entity adjusted variance, which will account for internal wallet transfers. So you can compare your standard MVRV to your entity adjusted MVRV, and that will clean up a lot of that, a lot of those internal transfers and things like that, and also exchanges and the like. But generally speaking, with exchanges, if you're looking at their hot wallets, because they're always on the move, they just kind of track price. So the way that MVRV, like the realized price for an exchange hot wallet is 1, because it's just like 1.1, 1.2, because it's just kind of moving with price. So in a way, it actually self-nullifies because it's kind of just moving around and not doing much. It's kind of the extremes that really make the MVRV sing. So in many ways, it's actually self-correcting, which is kind of neat. Great question. I get this all the time. How does tax loss harvesting affect MVRV? Tax loss harvesting will show up as a sale, right? Because somebody's moving their coins from a high price to a low price. But the other thing to think about that is that people always tax loss harvest. We're seeing the exact same behavior playing out time and time and time again. Human beings are making the same decisions collectively at the same time going, gee, it's a bear market. I'm very, very underwater. Some guy saying, I'm going to harvest that tax at the exact same time that some other guy goes, that's it. I hate this asset. Get me out of this thing. I'm done. I'm tired of seeing this red. The same behaviors show up with each cycle. So the answer is tax loss harvesting will show up and respond to this, or sorry, MVRV will respond to that, but it always responds to that. And human beings make the same decision every single time. So again, it's kind of one of these neat little self-correcting phenomena that, yeah, it happens, but it happens every cycle. So we're comparing apples and apples. Okay. Underlying assumption here of realized price is that it's essentially an acquisition. I think I kind of covered this. The answer is yes. On an individual basis, your error bars are a bit larger, but in aggregate, we continue to see that people tend to behave the same way over and over again. So it's kind of a funny situation. Can I calculate MVRV based on the API data? Yes, you can. It's literally spot price divided by realized price or market cap divided by realized cap. The only difference there is circulating supply will nullify and cancel each other out. Okay, what else do we have? Just trying to go through and find questions here that are separate. What is the name of the indicator and workbench with the only 2 bands of MVRV? It's called deviation bands. You'll find it under market indicators, I believe. If not, if you can't find anything that I went through in this presentation, dashboards, Bitcoin or Ethereum, profit and loss, and MVRV. It'll be sitting in there. Okay, let's keep going. Just trying to see if there's any more questions here that are kind of unique and different. Yeah, there's a point here about short-term and long-term holders. This is where, if you look at, in fact, in Workbench as well, you will find long-term and short-term or old and young supply MVRVs, which is just taking the ratio between their realized prices. You can use those to kind of segment the market into that hot money, cold money. And you can actually see these patterns play out time and time again. So you can compare standard MVRV, which is everybody, young supply MVRV, which is the fast hot money, and old supply MVRV, which is going to give you the older hands. And you'll see that during some periods of time, their behaviors are very similar. Typically during market extremes, they diverge significantly because the old supply is in huge profit. The young supply is they're at profit, but they're pretty much buying the top. So you'll see these things diverge. And then they'll also diverge in the opposite direction near market bottoms, because the old money is the ones from the previous cycle. All the smart old money's got out. And those old money who are left are kind of people who are holding the bag and, very, very red in their portfolio. And when you start to see them recover, which we're in the process of trying to get above, that's what we covered in the week on chain. That's the general framework for those. Okay, I think that's pretty much all the questions. There's one here on sovereign rollups, which I wish that I could answer. I actually haven't looked into it enough, so I can't give you any kind of a proper response on this one. But one thing I am very excited about, and we've seen this ordinals and inscriptions start to play out, at least from my personal perspective. The most exciting thing for me is that we have a wave of innovation that has come back to Bitcoin. And this is very exciting to see. And, I fall into the camp where Bitcoin is a pretty resilient and hard to kill animal. And if, inscriptions or sovereign rollups or any of these things kill Bitcoin, then it was destined to die. I believe that the amount of innovation and interest and renewed kind of engagement that's coming to both the development, but also the adoption space is very, very exciting. I think that Bitcoin will, I think it will thrive through this. We're going to learn a lot. We're going to build some cool things, and the network will expand and grow from there. And it's a resilient beast, so these things aren't going to kill it. So thank you everyone for tuning in. Hopefully you found that to be a useful session. We are looking forward to doing more of these. We'll try and get at least one more done for the month of March. If you do have any feedback or comments or questions following this, we will actually post this video and get it live for you all. So if you have any questions at all, either jump into Glassnode forum and ping us there, or feel free to send us a comment. But thank you for tuning in, and we will see you in the next one. Cheers.